Welcome to KPMG's first Exempt Healthcare Tax News Brief, hosted by the Development and Exempt Organizations Tax Practice. This ongoing series is intended to provide you with a quick snapshot of tax items impacting exempt healthcare organizations throughout the country by providing updates on issuance of new tax guidance, discussion of IRS audit activity, clarification on tax reform, or simply highlighting issues we see our clients struggling with every day. Today we will touch on the guidance that we received over the holidays pertaining to legislation formerly known as the Tax Cuts and Jobs Act, or tax reform. Santa wasn't the only one giving out gifts over the holidays this year. The IRS and Treasury are also busy issuing a flurry of guidance on issues affecting tax-exempt organizations. The first IRS gift we will look at is Notice 2018-99. This notice serves as interim guidance for taxpayers to use in determining the amount of expenses for qualified transportation fringe benefits, or QTF, and in particular for employee parking, that is non-deductible under Section 274A4 and therefore includable in an exempt organization's unrelated business taxable income, or UBTI. This provision is found in New Internal Revenue Code Section 512A7. Essentially, this notice rejected a fair market value approach to determining the amount to be included in UBTI and adopted a cost-based approach. The notice outlined both what costs are included and how to allocate those expenses to employee-related use versus general public use. It also provides for an exemption from including any amounts in UBIT where the use of the lot is primarily for public use, which is defined as greater than 50%. In order to apply the interim guidance, first you will need to determine whether they reserve any parking spaces for your employees. If you do, costs allocable to those reserved spaces will generally have to be included in UBTI. However, the notice also says that if an organization decides to make the spaces non-reserved by March 31, 2019, the spaces will be treated as never having been reserved at all. Next, organizations need to determine the use of the remaining unreserved spaces in their parking lots during normal business hours. If the number of those remaining spaces used by patients, students, customers, clients, visitors, and other members of the public, along with empty spaces, is more than the number of spaces used by employees, the cost allocable to the remaining spaces may be excluded from UBTI altogether. Remember, this determination needs to be made even in rural areas where the parking has no value. It's important to get ahead of this one and begin compiling the data to support the position that the organization's parking lots are primarily used by the general public. In related news, for those organizations that did not make required estimated tax payments owed as a result of Section 512A7, Notice 2018-100 waives any 6655 penalties for underpayment of those estimated taxes, provided the organization was not required to file a Form 990-T for its tax year preceding its first tax year ending after December 31, 2017. So, that should relieve some of the anxiety around this provision in the short term, at least for those that did not have to file a Form 990-T in the prior year. On the very last day of the year, the IRS also gave us another gift by issuing IRS Notice 2019-09, Interim Guidance on the Excise Tax, currently 21%, imposed under Section 4960 on excess remuneration greater than $1 million. This guidance attempts to answer some of the questions we've all had around the following. Number 1, what is an applicable tax-exempt organization? For instance, to what extent are governmental entities and their integral parts included? Number 2, what entities are considered related? Number 3, who is liable for the tax, especially in multi-entity systems? In general, what the notice says here is the common law employers are liable. There can be more than one employer, and each is expected to file Form 4720 and pay the tax. Number 4, what services are considered healthcare services eligible for exemption from the excise tax? Number 5, who is a covered employee? On this point, the notice clarifies that the 5 highest compensated each year are covered employees, regardless of whether the compensation exceeds $1 million. so employers will have to track their covered employee for the future because they could be subject to tax on compensation greater than $1 million, even in years where they are not top 5. As you can see, this is going to require record keeping, similar to keeping track of the substantial contributors for determining the amount of public support received by a charity for 990 Schedule A. Number 6. Excess parachute payments were also addressed, including how to calculate the excess parachute payment and the base amount, and 3 times the base amount. Also addressed was what is an involuntary separation from employment and when is a payment related to that separation. Number 7. Finally, in the notice, the IRS addresses how an applicable tax-exempt organization makes an excise tax payment, which is on a Form 4720, and when the payment is due, which is the 15th day of the 5th month after the end of the organization tax year, but can be extended by filing Form 8868. Organizations should note this will be an additional extension requirement that many organizations may not have had before. While there isn't enough time today to go through all the IRS Holiday Guidance, we do encourage you to check out the KPMG DAO website for the latest updates on tax issues impacting your organizations, and or to reach out to your KPMG engagement team. Hopefully this tax briefing helped you to become quickly updated on some of the key happenings in the tax-exempt world. Stay tuned for the next KPMG Exempt Healthcare news briefing to be announced soon. Thank you and have a good day.